Imagine standing at the edge of an infinite ocean, waves crashing unpredictably, some gentle, others violent. This is the reality of trading, a world where certainty is an illusion and success belongs not to the smartest but to the most disciplined. Trading in the Zone by Mark Douglas is not just a book. It's a psychological blueprint for mastering the inner battles that dictate market success. Why do traders, armed with the best strategies, still fail? Because markets don't reward knowledge. They reward unwavering confidence, emotional resilience, and the ability to think in probabilities rather than absolutes. Douglas unveils the hidden forces of fear, greed, and self-sabotage that cloud judgment, showing that true mastery isn't about predicting price movements, but about developing a mindset free from hesitation and doubt. This book is an invitation to transform the way you trade, shifting from chaos to clarity, from impulsiveness to discipline. Are you ready to step into the zone?
Chapter 1. The Road to Success: Fundamental, Technical, or Mental Analysis. Trading is a field where people spend years searching for the perfect strategy. Some believe the key lies in fundamental analysis, studying financial reports, economic data, and company earnings. They track news, monitor inflation rates, and follow government policies, hoping to predict where the market will move next. Their belief is that if they can just gather enough information, they will be able to stay ahead of the market and make the right trading decisions. They study charts, read reports, and constantly adjust their strategies based on new data. Yet, even with all this information, they still experience unexpected losses. Markets do not always react logically to news, and the same reports that should push prices up sometimes send them crashing down. Others take a different approach, relying entirely on technical analysis. Instead of focusing on economic data, they analyze price charts, patterns, and indicators. They believe that price movements reflect all known information, so studying past trends will reveal future opportunities. They use tools like moving averages, Fibonacci retracements, and candlestick patterns, trusting that history will repeat itself. When they find a setup that has worked before, they assume it will work again. But like those who rely on fundamental analysis, they too experience losses. Patterns that worked yesterday fail today. Indicators that once provided clear signals suddenly give false readings. Despite their knowledge and experience, they still struggle with inconsistency. The reason both groups fail is not because their methods are wrong. Both fundamental and technical analysis have their place in trading, but neither guarantees success. The missing piece is understanding how the mind interacts with the market. The market is a constantly shifting environment filled with uncertainty. No single event or pattern can be predicted with complete accuracy. Every trade is a unique event with an unknown outcome. Even if a setup looks perfect, there is no guarantee it will work this time. The biggest challenge traders face is not the market itself, but their own minds. The human brain is wired to seek patterns and certainty, but the market does not provide either. This creates a psychological struggle. Most traders try to impose order onto the market, searching for a strategy that will always work. They believe that if they can just refine their system enough, they will eliminate losses. But losses are an unavoidable part of trading. No matter how much research is done, no matter how many indicators are used, no one can predict the market with absolute certainty. The sooner a trader accepts this truth, the sooner they can move toward real success. The most successful traders do not focus on controlling the market. Instead, they focus on controlling themselves. They develop a mindset that allows them to trade without hesitation, without fear, and without emotional attachment to the outcome of any single trade. They understand that their goal is not to be right all the time, but to execute their plan consistently. They do not let a winning streak make them overconfident, and they do not let a losing streak shake their confidence. They trust their edge and stick to their process, knowing that their success is determined by long-term consistency, not short-term results. Many traders fall into the trap of thinking that the more they know, the better they will perform. They spend countless hours searching for more indicators, reading more books, and subscribing to financial news channels, hoping to gain an advantage. But no matter how much information they gather, they still struggle with losses. Some blame the market, some blame their strategy, and others give up entirely. What they fail to see is that their problem is not a lack of knowledge, but a lack of control over their own thoughts and emotions. The market does not reward intelligence alone. It rewards discipline, emotional control, and the ability to follow a plan without hesitation. Consistency is the key to success, and consistency comes from having a belief system that matches the true nature of the market. Traders who accept uncertainty, manage their risk, and focus on the process rather than the outcome are the ones who succeed. They know that losses are just part of the game, and they do not allow those losses to affect their confidence. Instead of approaching the market with a mindset of winning every trade, the best traders approach it with a mindset of following their process. They know that their edge will play out over time as long as they remain disciplined. They do not chase trades out of fear of missing out, and they do not hesitate to exit when their stop loss is hit. They remain in control at all times, regardless of what the market does. This ability to stay calm and focused in an environment of uncertainty is what separates successful traders from those who fail. Those who embrace this way of thinking find that trading becomes less stressful and more predictable over the long run. They no longer see losses as failures, but as part of the natural flow of the market. They do not waste time searching for the perfect system because they understand that success is not about having a flawless strategy. It is about becoming the kind of trader who can execute a plan with confidence, discipline, and consistency. Once a trader masters this mindset, everything changes. Trading stops being a constant battle of emotions and becomes a structured process. The highs and lows of the market no longer dictate their state of mind. They understand that their job is not to predict the future, but to manage risk and make decisions based on probabilities. They know that as long as they maintain discipline and follow their edge, success is inevitable. This shift in thinking is what truly separates the best traders from everyone else. Chapter 2: The Lure and Dangers of Trading. Trading appears to be one of the most exciting opportunities for financial freedom. The idea of being able to enter the markets, make quick profits, and live life on one's own terms is incredibly appealing. It offers a level of independence that few other professions can provide. There are no bosses, no fixed schedules, and no limits on earnings. Unlike traditional jobs that require years of experience or formal education, trading is accessible to anyone willing to participate. The markets do not discriminate. They allow anyone to enter, regardless of background, education, or financial status. This freedom is what draws so many people toward trading. The ability to make money from anywhere in the world with just a computer and an internet connection gives traders a sense of control over their financial destiny. Unlike most businesses that require employees, logistics, and capital investment, trading requires only an account and the knowledge to operate within the market. Many believe that if they can master the mechanics of buying and selling, they will unlock unlimited financial potential. The attraction grows even stronger when traders see the success of others. Stories of people who turn small investments into massive fortunes create the illusion that trading is a quick and easy path to wealth. The financial markets have always had examples of traders who made millions, sometimes in a single day. These success stories inspire new participants who enter with dreams of achieving the same results. They believe that with the right strategy and enough effort, they too can achieve financial freedom. However, the reality is much different. What is often hidden behind these success stories is the struggle, the discipline, and the psychological strength required to become consistently profitable. New traders rarely consider the emotional challenges involved. They focus on the excitement of making money, but ignore the possibility of losing it just as quickly. Most come in with expectations that are not aligned with the actual nature of the market. One of the biggest dangers is overconfidence. When traders experience early success, they believe they have found the key to the market. They assume they have superior knowledge or special insight that will allow them to win consistently. This illusion of control leads them to take bigger risks, believing that their understanding of the market is enough to protect them from losses. But trading is not about controlling the market. It is about managing risk. Without proper risk management, even the most skilled traders can experience devastating losses. Another danger is the emotional attachment to money. In everyday life, money represents security, comfort, and opportunity. Losing money can feel like losing personal security. This makes it difficult for traders to accept losses as a normal part of the process. Instead of seeing a losing trade as just one event in a long series, they react emotionally, trying to win back what they lost. This leads to revenge trading, placing trades out of frustration rather than logic. Instead of making rational decisions based on market behavior, traders allow emotions to dictate their actions. Many traders also struggle with the randomness of the market. Unlike a traditional job where effort is directly linked to results, trading does not reward effort alone. Someone can spend hours analyzing charts and making careful decisions, only to lose money due to unpredictable market movements. This lack of direct cause and effect can be frustrating, making traders feel as though they have no control. When they lose, they look for external reasons, blaming the market, news events, or other traders, rather than understanding that losses are simply part of the process. Another dangerous belief is the idea that the market must behave a certain way. Many traders enter with fixed expectations, believing that if they do everything correctly, the market will reward them. When the market moves against their expectations, they refuse to accept it. They hold on to losing trades longer than they should, believing the market will eventually correct itself in their favor. This attachment to a specific outcome prevents them from adapting to changing market conditions. Instead of exiting a trade when it no longer makes sense, they hold on, hoping for a reversal. This often leads to larger losses than if they had accepted the loss earlier. There is also the challenge of inconsistency. Many traders experience cycles of winning and losing. They may have periods of success, but those are often followed by long stretches of losses. This inconsistency creates emotional highs and lows, which can be exhausting. When they are winning, they feel confident and in control. But when they start losing, they question their ability, their strategy, and even themselves. This emotional roller coaster makes it difficult to stay focused and disciplined. The greatest danger, however, is the illusion that trading success comes from external factors rather than internal mastery. Many traders believe that if they find the right strategy, indicator, or trading system, they will become successful. They spend endless hours searching for the perfect method, jumping from one system to another, hoping to find a way to eliminate losses. This pursuit is an illusion because no strategy can guarantee success. The market is too unpredictable, and losses are inevitable. The key is not in finding a perfect system, but in developing the right mindset to handle uncertainty and risk. This is where most traders fail. They do not realize that the real challenge of trading is not in understanding the market, but in understanding themselves. The market does not create success or failure. Traders do. The way they react to wins and losses determines their long-term success. Those who fail often do so because they cannot control their emotions, manage risk, or accept uncertainty. They let fear, greed, and ego drive their decisions instead of approaching trading with discipline and patience. Those who succeed do so not because they avoid losses, but because they know how to handle them. They do not expect to win every trade. Instead, they understand that trading is a game of probabilities, where individual trades do not matter as much as the long-term outcome. They focus on execution rather than results, making sure each trade aligns with a clear, consistent process. The reality of trading is far different from the fantasy that attracts most people. It is not a quick path to riches, nor is it an easy way to make money. It requires deep self-awareness, emotional control, and an acceptance of uncertainty. Most traders do not fail because they lack knowledge or technical skill. They fail because they cannot manage their own psychology. Understanding this is the first step toward real success. Chapter 3. Taking responsibility. Taking responsibility is about understanding that success or failure in trading is entirely in one's hands. Many traders blame external factors such as the market, news events, or even other traders when things go wrong. However, the market itself is neutral. It does not act for or against anyone. The only force that determines the outcome of a trade is the trader's own decisions. Most traders do not realize that they bring their personal beliefs, fears, and past experiences into the market. These mental patterns shape the way they interpret price movements and influence their reactions. If someone has a history of avoiding responsibility in other areas of life, this behavior will show up in their trading as well. They might hesitate when they should act or act impulsively when patience is needed. They may take credit for their wins but blame the market for their losses. This way of thinking prevents growth because it shifts the focus away from where it should be, on self-improvement and discipline. Taking responsibility begins with accepting that every trade is a choice. No one is forcing a person to enter or exit a position. The decision to buy or sell is always made by the trader. If a trade goes wrong, the trader must analyze what went wrong without excuses. Did they ignore their strategy? Did they act out of fear or greed? Were they hoping instead of following logic? By answering these questions honestly, a trader can start making real progress. The moment blame is placed elsewhere, the opportunity to learn disappears. Many traders think that they must know exactly what the market will do next in order to be successful. This belief leads to frustration because no one can predict the future. The market is made up of thousands or even millions of participants, each making their own decisions. The movements of price are the result of these collective actions. Since no single person controls the market, trying to predict its behavior with certainty is impossible. Instead, a trader should focus on managing risk and following a set of rules that give them an edge over time. Risk is an unavoidable part of trading. Every trade carries a level of uncertainty, but many traders refuse to accept this fact. They enter trades expecting a guaranteed outcome, and when things don't go as planned, they become emotional. Some hold on to losing trades, hoping the price will turn around. Others jump into new trades immediately after a loss, trying to recover their money quickly. These reactions come from a refusal to take responsibility for risk. A successful trader knows that losses are normal and expected. They prepare for losses in advance by setting stop-loss orders and only risking an amount they are comfortable losing. They do not try to control the market. They control their own actions. Some traders fall into the trap of believing that if they just find the perfect strategy, they will never lose again. They spend years searching for a system that promises 100% accuracy, but this search is futile. No strategy can remove risk entirely. The real key to success is not a perfect system, but a disciplined mindset. A trader with an average strategy and strong discipline will always outperform a trader with the best strategy but poor discipline. The way a person reacts to winning and losing trades also reveals their level of responsibility. Some traders become overconfident after a few wins, believing they have figured out the market. They start taking bigger risks and ignoring their rules. This arrogance leads to large losses that wipe out their previous gains. Others become fearful after a loss, doubting their strategy and hesitating to take new trades. Both of these behaviors show a lack of responsibility. A responsible trader stays consistent regardless of wins or losses. They do not let emotions influence their decisions. They trust their strategy and follow it without deviation. Self-awareness is an essential part of responsibility. A trader must recognize their own emotional patterns and thought processes. This requires deep reflection and honesty. Many traders avoid looking at their mistakes because it is uncomfortable. It is easier to blame external factors than to admit personal flaws. However, real improvement only happens when a trader is willing to confront their weaknesses. A simple way to develop responsibility is by keeping a trading journal, writing down each trade, along with the reasons for entering and exiting, helps a trader see patterns in their behavior. If mistakes are repeated, the journal provides evidence of them. Over time, this awareness allows a trader to make necessary adjustments and improve decision-making. There is also a difference between knowing something intellectually and applying it in practice. Many traders understand that they need to take responsibility, but when they are in the middle of a trade, they forget everything. The pressure of live trading can cause even experienced traders to revert to old habits. This is why it is important to practice responsibility in small ways every day. Following rules consistently, accepting losses without frustration, and maintaining a calm mindset all contribute to long-term success. Responsibility in trading is not just about analyzing trades after they happen. It also means preparing properly before entering the market. A trader must define their risk in advance, know when they will exit, and have a clear reason for entering. Trading without a plan is gambling, and gambling leads to unpredictable results. Taking responsibility means approaching every trade with a structured and disciplined mindset. A key realization is that responsibility gives traders freedom. When a trader fully accepts that they are in control of their own actions, they no longer feel like victims of the market. They stop fearing losses because they understand that losses are a normal part of the process. They do not let wins inflate their ego because they know that trading is a probabilities game. This freedom allows traders to make decisions without emotional interference. Over time, taking responsibility leads to confidence. A trader who has developed this mindset no longer hesitates. They do not second-guess their trades or feel the need to seek reassurance from others. They trust themselves because they have done the necessary work to build discipline and self-awareness. They understand that they are not trying to beat the market, but rather to execute their own strategy consistently. The path to trading success is not about finding the right market conditions or predicting future price movements. It is about developing the ability to make sound decisions under pressure. This is only possible when a trader takes full responsibility for everything they do. They no longer waste time blaming the market or external factors. Instead, they focus on improving themselves and their approach. Each trade is an opportunity to practice responsibility. Whether the trade results in a win or a loss does not matter as much as how the trade was executed. If a trade follows the plan and the result is a loss, it is still a successful trade because the right process was followed. If a trade is won but was based on impulse rather than strategy, it is a failure because it reinforces bad habits. A responsible trader understands this difference and prioritizes process over outcome. As responsibility becomes a habit, trading becomes easier. The stress and frustration that many traders experience begin to fade. There is no longer a need to control the market because the trader is in control of themselves. Every decision is made with clarity and confidence. Mistakes are learned from rather than repeated. Trading stops being an emotional roller coaster and becomes a structured, disciplined process. In the end, taking responsibility is the most important step toward consistent success. It separates struggling traders from those who thrive in the markets. The transition from blaming external factors to owning every decision is what allows a trader to move from randomness to control, from frustration to clarity, and from failure to mastery. Chapter 4. Consistency, a state of mind. Consistency in trading is not about finding the perfect strategy or predicting every market movement correctly. It is a state of mind, a way of approaching the market that removes hesitation, fear, and emotional instability. Many traders enter the market hoping to win big, expecting certainty where none exists. This expectation leads to frustration, doubt, and ultimately failure. A trader who seeks consistency must first understand that markets are unpredictable on a trade-by-trade basis. No matter how much knowledge a person has, no one can predict exactly what will happen next. Markets are a collection of traders acting on their own beliefs, expectations, and fears. This creates a chaotic and ever-changing environment. Yet within this apparent randomness, patterns emerge over time. A professional trader does not focus on being right on any single trade. Instead, they focus on executing a plan that has a statistical edge over many trades. A major obstacle to consistency is the emotional attachment traders develop toward individual trades. This attachment comes from the belief that a trade must be successful for them to be a good trader. When a trade moves against them, panic sets in. They hesitate, close the trade early, or worse, hold on to losing positions in the hope that the market will reverse. This emotional response leads to inconsistent decision-making. The key is to detach emotionally from the outcome of a single trade and focus on executing the plan consistently. Risk management is an essential foundation for developing consistency. Without proper risk control, no trader can survive long enough to develop an edge. The best traders never risk more than they can afford to lose. They accept that losses are part of the process. Instead of trying to avoid losses altogether, they focus on limiting them while letting winning trades run. Every trade carries a level of uncertainty, and a good trader knows that losses are simply the cost of doing business. This mindset eliminates the fear of losing, allowing for disciplined execution. Confidence is another crucial aspect of consistency. Confidence in trading does not come from winning a few trades in a row. It comes from knowing that over a series of trades, the strategy will produce positive results. This confidence is built by following a structured approach to trading. When a trader follows their plan without hesitation, regardless of individual trade outcomes, they create consistency in their actions. Confidence grows as they see how their discipline leads to long-term success. A trader must train themselves to think in probabilities rather than certainties. Each trade is just one event in a larger series. Even a well-planned trade can result in a loss. This does not mean the strategy is flawed. Traders who seek consistency understand that the outcome of a single trade is irrelevant. What matters is how well they execute their edge over time. If the strategy has a statistical advantage, then sticking to it without emotional interference will produce reliable results. Discipline is the bridge between a good strategy and actual success. Many traders develop a plan, but fail to follow it when emotions take over. They take impulsive trades outside of their plan, chase the market, or close trades too early. These mistakes create an unpredictable pattern of behavior, which leads to inconsistent results. True discipline comes from committing to a structured process and following it regardless of market fluctuations. Another challenge traders face is the temptation to seek immediate rewards. The market does not operate on a schedule that guarantees quick profits. Traders who constantly switch strategies in search of instant success never develop the consistency needed for long-term gains. Instead of focusing on short-term results, they should commit to a process and give it time to prove itself. The traders who succeed are the ones who stick to their rules and allow their edge to play out over a large sample size. A consistent trader also knows how to manage expectations. Many people enter trading with the hope of getting rich quickly. This mindset leads to reckless decision-making, excessive risk-taking, and emotional instability. A trader must accept that there will be ups and downs. The goal is not to make money on every trade, but to execute a well-defined plan over and over again. Those who accept this truth are able to trade with confidence, knowing that losses are simply part of the process and not a reflection of their skill or intelligence. Another common mistake traders make is assuming that past patterns will always repeat in the same way. While history can provide insights, no two market conditions are ever identical. The traders participating today are not the same as those who participated in past price movements. Their motivations, emotions, and strategies are different. This is why even the most reliable setups can fail unexpectedly. Rather than assuming that the market will behave a certain way based on past data, traders must remain flexible and open-minded. They must adapt to what the market is showing them rather than imposing their expectations on it. Risk management is the only true control a trader has. Since the market cannot be predicted with certainty, the focus should not be on trying to eliminate risk, but on managing it effectively. This means defining risk before entering a trade, setting stop-loss levels, and ensuring that no single trade has the power to significantly damage the trading account. Those who ignore risk management often find themselves caught in emotional cycles, where a single large loss can lead to fear-driven decisions that create even more losses. A trader who respects risk understands that losses are inevitable but manageable. The ability to remain emotionally neutral is crucial. The market will not always behave in a way that aligns with expectations. There will be trades that look perfect on paper but fail in execution. There will be times when profits quickly turn into losses. Those who react emotionally to these fluctuations will struggle to make rational decisions. They will hesitate when they should act, chase after moves they have already missed, and abandon strategies that are fundamentally sound. Emotional trading leads to inconsistency, which is the biggest obstacle to long-term success. To develop a strong trading mindset, one must practice seeing the market objectively. This means removing personal biases and focusing on what the market is actually doing, rather than what one hopes it will do. It requires a shift in perspective, where the market is no longer seen as something to conquer or outsmart, but as a neutral environment where opportunities exist for those who can remain disciplined. Traders who achieve this level of detachment do not react emotionally to individual trades. They execute their strategies with confidence, knowing that losses are part of the game and do not define their ability. One of the greatest challenges in trading is overcoming the natural human tendency to seek certainty. People want to feel secure in their decisions, but the market offers no guarantees. The sooner a trader accepts this, the easier it becomes to trade with clarity and confidence. Instead of searching for the perfect strategy that will always work, a trader must develop a mindset that allows them to operate effectively in an uncertain environment. This means letting go of the need for perfection and focusing instead on consistency, discipline, and risk management. Success in trading is not about predicting what will happen next. It is about executing trades with a well-defined plan, managing risk effectively, and maintaining emotional stability. Those who can do this will find that trading becomes less stressful and more rewarding. The market does not create winning or losing traders. Traders create their own results based on how they interact with the market. Those who learn to align with the realities of the market, rather than fight against them, will achieve the kind of consistency that leads to long-term success. Chapter 5. The Dynamics of Perception. Perception shapes reality in trading. Every trader looks at the same market data, yet no two traders interpret it the same way. This difference in perception is what separates consistent traders from those who struggle. The mind filters information based on past experiences, fears, and expectations, making it difficult to see the market objectively. The human brain does not process information in a neutral way. Instead, it evaluates every new experience based on what has happened before. This means that two traders can see the same price movement and come to completely different conclusions. One might see an opportunity, while the other sees a threat. The difference lies in their beliefs and past experiences. Someone who has suffered repeated losses in a particular market condition might unconsciously expect failure again, even when the conditions are favorable. This expectation influences decision-making, causing hesitation or overconfidence. Most traders believe they see the market as it is. However, the truth is that their minds create a version of reality shaped by personal experiences. The subconscious mind plays a significant role in how information is perceived. If a trader has been conditioned to associate certain market patterns with loss, they will likely feel discomfort when those patterns appear again, even if the circumstances are different. This emotional response can lead to impulsive or fearful decisions. A major challenge in trading is learning to see price movements without emotional bias. Fear, hope, and regret distort judgment. Fear causes traders to hesitate, preventing them from taking profitable opportunities. Hope leads them to hold on to losing trades longer than they should. Regret forces them to chase after trades they previously ignored, usually at a much worse entry point. These emotions stem from deeply ingrained beliefs about money, risk, and success. The process of changing perception begins with awareness. Traders must recognize that their view of the market is not absolute truth, but rather an interpretation. This realization allows them to step back and question their reactions. Every time hesitation or fear arises, it is an opportunity to examine the underlying beliefs that create those feelings. A trader who consistently exits trades too early out of fear of loss should ask what past experiences have contributed to that habit. Perhaps they suffered a significant loss once and have since associated staying in a trade with danger. By identifying these mental patterns, traders can start to break free from them. Confidence in trading comes from certainty in one's ability to execute decisions without emotional interference. This is not the same as being certain about market direction. The market is unpredictable, and no system can guarantee consistent profits. However, certainty in one's ability to follow a plan removes hesitation and second-guessing. When a trader reaches this level of confidence, they no longer fear losses because they trust their process. They understand that a single trade is just one outcome in a series, and that the law of probabilities will work in their favor over time. The way information is processed also affects risk perception. A trader who has been conditioned to expect loss may see every trade as a risk rather than an opportunity. This leads to a defensive approach where trades are closed too quickly or opportunities are missed entirely. On the other hand, a trader who has experienced a long winning streak may develop an illusion of control, believing they can predict the market. This overconfidence leads to reckless decisions and unnecessary losses. Both perspectives are flawed because they are based on emotions rather than objective analysis. Learning to view the market objectively requires detaching from personal beliefs about money and success. Money carries strong emotional associations, often tied to self-worth and security. A trader who fears losing money may unconsciously sabotage profitable trades because their mind associates financial loss with personal failure. The key is to separate trading results from personal identity. Winning or losing a trade does not define intelligence or worth. When this separation occurs, trading decisions become clearer and less emotionally driven. The brain naturally seeks patterns to make sense of the world. This tendency is useful in many aspects of life, but can be dangerous in trading. The market operates in probabilities, not certainties. However, traders often convince themselves that they see repeating patterns that will guarantee success. This belief creates unrealistic expectations and leads to frustration when the market does not behave as anticipated. The ability to accept uncertainty is one of the most important skills a trader can develop. When a trader stops trying to force patterns onto the market, they become more flexible and responsive to real opportunities. Experience does not automatically lead to better perception. Many traders with years of experience still struggle because they have not corrected their biases. Repeating the same mistakes over time only reinforces faulty beliefs. Growth comes from actively questioning and adjusting one's thought process. Traders who succeed long-term continually refine their perception, ensuring they are not trapped by past experiences. The market does not generate emotions. It only triggers emotions that already exist within the trader. If a trader feels intense fear before placing a trade, the fear is not caused by the market, but by personal associations with risk and loss. Recognizing this truth shifts focus from blaming external factors to addressing internal mindset. Once a trader takes responsibility for their perception, they gain control over their reactions. Instead of being driven by fear or greed, they can make decisions based on logic and probability. Achieving an objective mindset requires training. Just as an athlete develops muscle memory through repetitive practice, a trader must repeatedly expose themselves to the market with a controlled approach. This means following a structured trading plan, managing risk properly, and analyzing trades without emotional attachment. Over time, this process rewires the brain to respond differently to market fluctuations. What once triggered fear or excitement becomes just another event in a larger series. The goal is to reach a state where trading decisions are made with clarity and confidence, free from hesitation or impulsiveness. This state is not achieved through knowledge alone, but through consistent mental conditioning. Traders must actively challenge their beliefs, question their emotional responses, and refine their perception until they can see the market as it is, rather than how they fear or hope it to be. When this level of awareness is reached, trading becomes a controlled and disciplined process rather than an emotional struggle. Chapter 6: The Market's Perspective. The market is a vast, ever-changing entity, shaped by millions of traders, each with their own beliefs, expectations, and emotions. It does not think, nor does it have an agenda. It simply moves, reflecting the collective actions of those who participate in it. Many traders enter the market believing they can control or predict what will happen next, but this mindset leads to frustration and failure. The market does not owe anyone success or follow any individual's expectations. It exists independently of personal desires and reacts only to the decisions made by traders around the world. A trader must understand that the market is neutral. It does not care whether someone wins or loses. It does not reward hard work or punish mistakes. It simply moves according to the collective forces of supply and demand. Traders who take losses personally often struggle because they see the market as an opponent rather than an environment to navigate. There is no fairness or justice in trading, only the realities of price movement. This realization can be difficult, but it is essential for developing a mindset that allows for consistent success. Each price movement is the result of countless decisions made by traders at any given moment. Some are buying, believing prices will rise, while others are selling, expecting them to fall. There is no single reason why the market moves in a certain direction. The same piece of news or data can lead to different reactions among different traders. Some may see it as a reason to buy, while others interpret it as a reason to sell. This is why trying to assign meaning to every market movement is a waste of time. The market moves because traders make decisions, and no one can fully understand the reasons behind each decision. Most traders struggle because they expect the market to behave in a way that aligns with their personal beliefs. They assume that if they analyze data correctly, the market will respond accordingly. But the market does not function according to personal logic. It follows its own rules, driven by factors that no single trader can fully comprehend. This is why even the best analysis does not guarantee success. A setup that worked perfectly in the past may fail in the future simply because different traders are participating at that moment. Expecting certainty from an inherently uncertain system creates unnecessary stress and frustration. The unpredictability of the market often leads traders to seek control where none exists. They try to force outcomes by overanalyzing, hesitating, or adjusting strategies based on short-term results. This approach is counterproductive. The more a trader attempts to control the market, the more emotionally attached they become to each trade. When a trade goes against them, they take it personally, believing the market is deliberately working against them. This emotional attachment clouds judgment, leading to impulsive decisions that increase losses. The market is not personal. It simply reacts to the decisions of all traders combined. A trader must learn to detach from the need to be right. Many enter the market believing that success comes from predicting price movements with accuracy. But the market does not reward those who predict correctly. It rewards those who manage risk and follow a disciplined approach. A trader who wins by chance but lacks discipline will eventually give back their profits. Consistency is not about being right all the time, but about managing trades in a way that leads to long-term profitability. To trade effectively, one must accept that anything can happen at any time. There is no such thing as a guaranteed outcome. The best a trader can do is place trades based on probabilities, not certainties. A well-thought-out trade can still result in a loss, and a poorly planned trade can sometimes win. The outcome of a single trade is irrelevant. What matters is how trades are managed over time. Those who accept this truth are able to trade with confidence, knowing that losses are simply part of the process and not a reflection of their skill or intelligence. Another common mistake traders make is assuming that past patterns will always repeat in the same way. While history can provide insights, no two market conditions are ever identical. The traders participating today are not the same as those who participated in past price movements. Their motivations, emotions, and strategies are different. This is why even the most reliable setups can fail unexpectedly. Rather than assuming that the market will behave a certain way based on past data, traders must remain flexible and open-minded. They must adapt to what the market is showing them rather than imposing their expectations on it. Risk management is the only true control a trader has. Since the market cannot be predicted with certainty, the focus should not be on trying to eliminate risk, but on managing it effectively. This means defining risk before entering a trade, setting stop-loss levels, and ensuring that no single trade has the power to significantly damage the trading account. Those who ignore risk management often find themselves caught in emotional cycles, where a single large loss can lead to fear-driven decisions that create even more losses. A trader who respects risk understands that losses are inevitable but manageable. The ability to remain emotionally neutral is crucial. The market will not always behave in a way that aligns with expectations. There will be trades that look perfect on paper but fail in execution. There will be times when profits quickly turn into losses. Those who react emotionally to these fluctuations will struggle to make rational decisions. They will hesitate when they should act, chase after moves they have already missed, and abandon strategies that are fundamentally sound. Emotional trading leads to inconsistency, which is the biggest obstacle to long-term success. To develop a strong trading mindset, one must practice seeing the market objectively. This means removing personal biases and focusing on what the market is actually doing, rather than what one hopes it will do. It requires a shift in perspective, where the market is no longer seen as something to conquer or outsmart, but as a neutral environment where opportunities exist for those who can remain disciplined. Traders who achieve this level of detachment do not react emotionally to individual trades. They execute their strategies with confidence, knowing that losses are part of the game and do not define their ability. One of the greatest challenges in trading is overcoming the natural human tendency to seek certainty. People want to feel secure in their decisions, but the market offers no guarantees. The sooner a trader accepts this, the easier it becomes to trade with clarity and confidence. Instead of searching for the perfect strategy that will always work, a trader must develop a mindset that allows them to operate effectively in an uncertain environment. This means letting go of the need for perfection and focusing instead on consistency, discipline, and risk management. Success in trading is not about predicting what will happen next. It is about executing trades with a well-defined plan, managing risk effectively, and maintaining emotional stability. Those who can do this will find that trading becomes less stressful and more rewarding. The market does not create winning or losing traders. Traders create their own results based on how they interact with the market. Those who learn to align with the realities of the market, rather than fight against them, will achieve the kind of consistency that leads to long-term success. Chapter 7. The Trader's Edge. The key to trading success lies in having a mental advantage that allows for consistent and disciplined decision-making. It is not about predicting the market, but about managing risk and developing a structured approach. Traders who excel have developed a mindset that enables them to remain unaffected by the emotional swings of wins and losses. They have trained themselves to think in probabilities and understand that individual trades are insignificant in the grand scheme of their trading career. A successful trader knows that the market moves in patterns, but no single trade can guarantee an outcome. Each trade has an uncertain result, and the only way to succeed is to take a series of trades that follow a well-defined edge. This edge is not a secret formula or a magical indicator. It is the ability to execute trades consistently, without hesitation or fear, knowing that a properly executed plan will yield profits over time. Understanding how to gain an edge in trading requires accepting the fact that losses are a natural part of the process. Many traders struggle because they believe that losses indicate failure. This mindset causes hesitation, fear, and emotional trading, which leads to further losses. A skilled trader, however, understands that trading is a game of probabilities. No one wins all the time, and no single trade defines success. The real measure of a trader is how well they follow their plan and maintain consistency in their actions. Consistency is developed through proper risk management. A trader must determine how much they are willing to risk on each trade and ensure that no single loss can significantly impact their overall capital. Many traders fail because they risk too much, allowing emotions to take over when the market moves against them. A professional trader, on the other hand, treats trading as a business and calculates risk carefully. They never let one trade dictate their emotions or affect their future decisions. Every trade has an outcome that falls into one of four categories: a big win, a small loss, or a big loss. The goal is to eliminate big losses, as they are the primary reason traders fail. By cutting losses quickly and letting profitable trades run, the trader ensures that the overall results remain positive even if some trades are not successful. The focus is not on being right every time, but on maintaining a profitable strategy over many trades. One of the biggest obstacles to gaining an edge is the inability to follow a trading plan consistently. Many traders abandon their plan when they experience a few losses, believing that something is wrong with their strategy. This creates a cycle of constantly changing methods, which leads to frustration and further losses. The traders who succeed are the ones who trust their edge and execute their trades without hesitation. They do not let short-term outcomes affect their long-term confidence. Another crucial aspect of developing a trader's edge is eliminating emotional reactions to market movements. Fear and greed are the two emotions that drive most traders to make poor decisions. Fear causes hesitation, leading to missed opportunities or exiting trades too soon. Greed, on the other hand, leads to overtrading and taking excessive risks. A successful trader has trained their mind to remain detached from emotions, allowing them to make clear, objective decisions. One of the most important skills a trader can develop is the ability to take responsibility for every trade. Many traders blame the market, the news, or external factors when they lose money. This mindset prevents growth because it removes the ability to learn from mistakes. A professional trader understands that the market is neutral and that every decision is their own. By accepting full responsibility, they gain control over their results and can make necessary adjustments to improve their performance. Thinking in probabilities is the foundation of a trader's edge. Each trade is just one instance in a larger series, and no individual outcome matters in the long run. What matters is executing trades based on a clear, defined edge and allowing probability to play out over time. Traders who understand this concept do not become overly excited about wins or discouraged by losses. They remain focused on their process and trust in their system. A common mistake among traders is seeking certainty in the market. Many believe that if they find the right strategy or indicator, they will be able to predict future price movements with accuracy. This is an illusion. The market is unpredictable, and no strategy will work every time. The only certainty in trading is uncertainty, and the best traders have accepted this fact. They do not try to control the market, but instead control their own actions. To develop an edge, a trader must approach the market with a structured mindset. They must have a clear set of rules for entry, exit, and risk management. These rules should be followed consistently, without deviation. When a trader deviates from their plan due to emotions or impulsive decisions, they lose their edge. The most successful traders have trained themselves to follow their rules without question, knowing that discipline is the key to long-term success. One of the biggest challenges in trading is dealing with losing streaks. Even the best traders experience periods where their strategy does not produce profits. The difference between success and failure lies in how a trader responds to these periods. Many traders panic, abandon their plan, or take reckless trades to recover losses quickly. This often leads to more losses. A skilled trader, however, understands that losses are temporary and part of the game. They stick to their strategy, remain disciplined, and wait for their edge to play out over time. Patience is another critical element of a trader's edge. Many traders feel the need to be in the market at all times, fearing that they might miss an opportunity. This leads to overtrading and taking low-quality setups. A disciplined trader waits for the right conditions to appear before entering a trade. They do not let boredom or impatience dictate their decisions. By waiting for high-probability setups, they increase their chances of success and avoid unnecessary risks. Having a strong edge in trading also means understanding the role of self-doubt. Many traders hesitate to take trades because they fear losing money or making a mistake. This hesitation leads to missed opportunities and second-guessing decisions. Confidence in trading comes from experience and trust in the system. A trader who has tested their strategy and proven its effectiveness over time will execute trades with certainty, knowing that the outcome of any single trade does not define their success. A trader's edge is built over time through repetition and continuous improvement. Successful traders do not rely on luck or intuition. They follow a structured process that has been refined through experience. They keep a trading journal, analyze their trades, and identify areas for improvement. This allows them to correct mistakes, strengthen their discipline, and build confidence in their abilities. Another key factor in developing an edge is maintaining a positive mindset. Many traders dwell on past losses, which affects their future decisions. They carry emotional baggage into new trades, leading to hesitation and fear. A strong trader focuses on the present and does not let past experiences cloud their judgment. They understand that each trade is independent and has no connection to previous trades. By keeping a clear mind, they make better decisions and improve their overall performance. Understanding the importance of execution is vital to maintaining an edge. Many traders have a solid strategy, but fail to execute it properly due to hesitation or overanalysis. They wait for confirmation, seek additional information, or let emotions interfere with their decisions. The best traders have trained themselves to execute their plan without hesitation. They trust their analysis, enter trades with confidence, and accept the outcome without regret. Developing a trader's edge is a continuous process. The market is always changing, and traders must adapt to new conditions. Those who remain rigid in their approach often struggle when market dynamics shift. A skilled trader is always learning, refining their strategy, and staying flexible. They do not resist change but embrace it, knowing that adaptability is a crucial factor in long-term success. A true edge in trading is not about having the perfect strategy or predicting the market with certainty. It is about having the mental strength to follow a plan consistently, manage risk effectively, and remain emotionally detached from outcomes. The best traders have mastered their psychology, allowing them to operate with confidence and discipline. They do not seek perfection, they seek consistency. By thinking in probabilities, managing risk, and maintaining a structured approach, they create a sustainable path to success. Chapter 8. Thinking in Probabilities. Thinking in probabilities is the foundation of successful trading. The market is unpredictable, and no system or strategy can guarantee success on every trade. The key to long-term success is understanding that each trade is just one event in a larger series. A single outcome is irrelevant when looking at the bigger picture. Many traders fall into the trap of expecting certainty in an environment that offers none. They believe that if they find the right strategy, they will never lose. This belief leads to frustration, hesitation, and emotional reactions when trades go against expectations. A successful trader knows that any trade can result in a win or a loss, regardless of how perfect the setup appears. The goal is not to be right on every trade, but to execute trades with a well-defined edge. An edge is a set of conditions that, over a series of trades, will produce consistent profits. Just like a casino operates with a statistical advantage over players, traders must think in terms of probabilities rather than individual outcomes. When a casino offers a game, it does not expect to win every round. Instead, it relies on the law of large numbers, knowing that over hundreds or thousands of rounds, the odds will work in its favor. Traders who fail to think in probabilities treat each trade as an isolated event, making them emotionally attached to the result. When a trade wins, they feel confident, and when a trade loses, they feel defeated. This emotional cycle creates inconsistency because decisions are influenced by recent experiences rather than a structured approach. Instead of focusing on individual wins or losses, successful traders focus on executing their plan flawlessly. If they enter trades based on their defined edge and manage risk correctly, they have already succeeded, regardless of the immediate outcome. The problem many traders face is that they hesitate when placing trades. They analyze too much, looking for a guarantee that does not exist. This hesitation stems from the fear of loss, but losses are an unavoidable part of trading. The best approach is to accept that losses will happen and to make sure they are controlled. The worst mistake is trying to avoid losses at all costs by constantly changing strategies or overanalyzing the market. This creates inconsistency and prevents the trader from ever seeing the true results of their edge. Risk management plays a crucial role in probability-based thinking. Each trade should have a predefined risk amount that the trader is comfortable losing. When risk is controlled, fear is minimized. The moment risk is uncertain or too large, emotions take over, and logical decision-making disappears. Professional traders understand that they cannot control the market, but they can control how much they lose on any given trade. This mindset allows them to stay in the game long enough to let their edge play out over time. One of the biggest mistakes traders make is revenge trading. When a trade results in a loss, they feel the need to immediately recover that loss by taking another trade, often without proper analysis. This emotional reaction usually leads to further losses because the decision is not based on probability, but on frustration. A disciplined trader accepts the loss, moves on, and waits for the next opportunity that aligns with their strategy. Consistency in execution is what separates successful traders from those who fail. Many traders only follow their plan when they feel confident, but as soon as they experience a few losses, they abandon it. This inconsistency destroys the effectiveness of any strategy because it prevents the trader from fully realizing their edge. The key is to commit to executing the plan flawlessly, regardless of recent results. A well-defined edge works over a series of trades, not in every individual trade. One common mistake is adjusting position size based on emotions. After a winning streak, traders often become overconfident and increase their position size beyond their normal risk. This exposes them to significant losses when the inevitable losing trade occurs. On the other hand, after a losing streak, traders often reduce their position size or hesitate to take the next trade, missing opportunities. The correct approach is to keep risk consistent and based on the overall plan, not on recent wins or losses. A probability-based mindset removes the pressure to be right. Traders who need to be right all the time suffer from emotional swings that affect their performance. The best traders do not concern themselves with being right or wrong on individual trades. Their focus is on executing their edge over a large number of trades. This detachment from individual outcomes allows them to remain calm and objective, leading to better decision-making. The market is random in the short term, but over time, patterns emerge. A trading edge is based on these patterns repeating with a probability greater than 50%. However, even an edge that wins 60% of the time means that 4 out of 10 trades will be losers. Many traders fail because they expect every trade to win, and when they experience a few losses, they abandon their plan. The reality is that losses are part of the process, and they should be accepted without emotional reaction. A practical way to develop a probability-based mindset is by keeping detailed records of trades. By tracking every trade, including the reasoning behind it and the outcome, traders can analyze their performance over a large sample size. This reinforces the idea that success is determined by long-term results rather than individual trades. It also helps identify mistakes and areas for improvement. Traders must also avoid external influences that create unnecessary doubt. The financial media, other traders' opinions, and social media can all cloud judgment and lead to second-guessing decisions. A trader who has a defined edge and a probability-based mindset does not need outside confirmation. They trust their process and remain focused on executing it without distraction. Many traders struggle because they let past experiences dictate their future decisions. A loss on the previous trade should have no effect on the next trade, yet many traders hesitate because they remember the pain of a previous loss. This hesitation causes them to miss opportunities or enter trades too late, reducing their edge. Every trade is independent of the last, and each should be approached with the same level of confidence. Successful traders also accept that sometimes they will enter the market at the perfect time and still lose. The market does not operate in a way that guarantees results based on perfect analysis. There will always be times when everything lines up, yet the trade fails. Accepting this reality is crucial to maintaining emotional stability. When traders stop expecting certainty, they free themselves from the emotional burden that leads to inconsistent decisions. Traders who focus on probability do not take losses personally. A losing trade is not a reflection of their intelligence or skill. It is simply part of the statistical outcome of trading. The moment a trader attaches personal meaning to losses, emotions take control. This leads to hesitation, overtrading, and a lack of discipline. Keeping losses in perspective allows traders to remain focused on the bigger picture. One way to reinforce probability-based thinking is by mentally preparing before each trading session. Before placing trades, traders should remind themselves that they do not need to win every trade to be successful. They should accept the uncertainty of each outcome while maintaining confidence in their edge. This preparation reduces the impact of emotional reactions during the trading day. Another important aspect is setting realistic expectations. Many traders enter the market believing they will make money immediately or that they can avoid losses altogether. This mindset leads to frustration and poor decision-making when reality does not match expectations. Understanding that trading is a process that requires patience and discipline prevents unrealistic expectations from interfering with performance. Developing a probability-based mindset takes time and practice. It requires letting go of the need for certainty and embracing the randomness of short-term market movements. The transition from an emotional trader to a disciplined trader is not immediate, but with consistent effort, it becomes second nature. The goal is to reach a state where each trade is executed with confidence, without hesitation or fear. The best traders are not those who predict the market with perfect accuracy, but those who remain disciplined regardless of the outcome. They understand that trading success is measured over a series of trades, not by a single event. By thinking in probabilities, they free themselves from emotional swings and trade with clarity and confidence. Chapter 9. The Nature of Beliefs. Understanding how beliefs shape trading decisions is one of the most important aspects of achieving consistency in the market. Every trader comes to the market with a set of beliefs, formed by past experiences, personal perceptions, and societal influences. These beliefs create the lens through which market information is processed. However, the problem is that these beliefs are often rigid and do not align with the reality of the market, which is fluid and constantly changing. Traders who fail to recognize the role of their beliefs often struggle to adapt, leading to repeated mistakes and inconsistent results. Beliefs are formed through experiences, and they define how reality is perceived. If a trader has experienced a series of losses early in their journey, they might develop a belief that trading is extremely difficult or even rigged against them. This belief, once established, influences every trading decision moving forward. When opportunities arise, they may hesitate, expecting failure. When a trade moves in their favor, they might exit too soon, fearing that the market will turn against them. These actions are not based on actual market behavior, but on the trader's internal expectations, which have been shaped by past experiences. It is crucial to understand that beliefs are neither true nor false. They are simply perspectives that have been reinforced over time. A belief that the market is unpredictable can be just as limiting as a belief that the market is completely predictable. Both views are extremes that do not align with reality. The market operates on probabilities, not certainties, and traders who accept this idea can develop a more flexible mindset. Instead of clinging to rigid beliefs, they start seeing the market as a place of endless possibilities, where anything can happen at any time. Once a belief is accepted as truth, the mind filters out information that contradicts it. This is why two traders can look at the same chart and see completely different opportunities. If a trader believes that a particular stock will always rise after a specific technical pattern appears, they will look for confirmation of this belief and ignore instances where the pattern failed. This selective perception creates a dangerous cycle where the trader reinforces their belief, even when it is not always accurate. This is why many traders hold on to losing trades, convinced that the market must turn in their favor, because their belief system does not allow them to accept an outcome that contradicts their expectations. There is a strong connection between beliefs and emotions. A trader who believes that losses are failures will experience strong emotional reactions every time a trade goes against them. They might feel anger, frustration, or even fear of placing another trade. These emotions further strengthen the belief that trading is risky or that they are not capable of success. On the other hand, a trader who believes that losses are a natural part of the trading process will react differently. They will not take losses personally, but will instead see them as necessary learning experiences. This mindset allows them to move forward with confidence and without emotional baggage. Changing beliefs is not easy, but it is possible. The first step is self-awareness. Traders must examine the beliefs they hold about the market, money, and risk. Many of these beliefs operate at a subconscious level, influencing decisions without the trader even realizing it. By bringing them into conscious awareness, traders can begin to question their validity. Is it really true that the market is against them? Is it true that one bad trade defines their ability as a trader? Asking these questions helps to break the cycle of automatic thinking and opens the door to new perspectives. The second step is to replace limiting beliefs with more useful ones. This is not about forcing positive thinking, but about adopting beliefs that align with the actual nature of the market. Instead of believing that trading is unpredictable, a more useful belief is that trading outcomes are based on probabilities. Instead of believing that losses are failures, a more useful belief is that losses are simply the cost of doing business. These shifts in perspective allow traders to approach the market with a sense of detachment and clarity, making it easier to follow their trading plan without emotional interference. Reinforcing new beliefs requires repetition and experience. Just as limiting beliefs were formed through repeated exposure to negative experiences, new beliefs must be strengthened through consistent practice. This means taking trades with full acceptance of the risks, following a structured trading plan, and evaluating results objectively. Over time, the mind begins to accept these new perspectives as reality, making it easier to act in alignment with them. Beliefs do not just influence how traders interpret market information, they also shape how traders see themselves. Many traders struggle with self-doubt, questioning whether they have what it takes to be successful. This self-doubt is often rooted in deeper beliefs about personal worth and capability. A trader who believes that they are not good enough will always find reasons to confirm this belief, even if they have a profitable strategy. They might sabotage themselves by breaking their own rules, hesitating on good trades, or exiting too early. The problem is not their technical skills, but their self-image, which needs to be transformed. To change self-image, traders must start seeing themselves as consistent and disciplined traders, even before they achieve success. This is not about faking confidence, but about acting in accordance with the mindset of a successful trader. If a successful trader accepts losses with ease, then aspiring traders must do the same. If a successful trader follows their plan without hesitation, then developing traders must practice doing so as well. By consistently behaving in a way that aligns with success, the mind gradually accepts this new identity as reality. One of the biggest obstacles to changing beliefs is fear. Fear of losing, fear of being wrong, fear of missing out. These emotions stem from deeply held beliefs about what loss and failure mean. A trader who fears losing money often equates losses with personal failure. This belief creates intense pressure, making it difficult to execute trades with confidence. Instead of seeing losses as a normal part of trading, they see them as a reflection of their worth. This emotional burden prevents them from taking the actions necessary for success. The way to overcome fear is through understanding and acceptance. Losses will happen. The market is uncertain. There is no guarantee of success. These are facts, not personal failures. Accepting these truths removes the emotional charge associated with trading decisions. A trader who truly accepts that anything can happen will not react emotionally to unexpected outcomes. They will remain focused, disciplined, and prepared to act based on probabilities rather than emotions. Beliefs are powerful because they determine what is possible. A trader who believes that consistency is attainable will take the necessary steps to achieve it. They will develop discipline, refine their strategy, and approach trading with patience. On the other hand, a trader who believes that success is impossible will find ways to confirm this belief, whether by making impulsive decisions, avoiding responsibility, or quitting altogether. Success begins in the mind. It is not the market that determines a trader's fate, but the beliefs they hold about themselves and their abilities. The ability to think objectively is what separates successful traders from those who struggle. Objectivity comes from freeing the mind from rigid beliefs and expectations. Instead of trying to force the market to behave a certain way, traders must learn to observe and adapt. This means letting go of attachment to individual trades, embracing uncertainty, and trusting the process. When traders release themselves from limiting beliefs, they enter a state of flow where trading becomes effortless and decisions are made with clarity. Everything in trading comes down to the mind. Strategies and techniques matter, but without the right beliefs, even the best system will fail. The key to success lies in recognizing the power of beliefs, questioning those that are limiting, and replacing them with perspectives that support consistent, disciplined trading. Those who master their beliefs master the market, not because they control it, but because they control themselves. Chapter 10. The Impact of Expectations. Expectations play a powerful role in how traders perceive the market, make decisions, and react to outcomes. When entering a trade, there is often a deep, unconscious belief that the market should behave in a certain way. This belief is formed through past experiences, technical analysis, or even intuition. However, the market is an unpredictable and ever-changing environment, and when reality does not match expectations, it triggers a strong emotional response. This response can range from frustration and doubt to outright panic. The key issue with expectations is that they create a false sense of certainty. A trader might analyze a setup, see a pattern they recognize, and assume that the market should move in a particular direction. This expectation is reinforced by past trades where similar conditions led to profits. However, this overlooks a fundamental truth. No two market conditions are exactly the same, and no setup guarantees a specific outcome. The expectation of certainty leads to disappointment when the trade does not unfold as anticipated. This disappointment can be dangerous. When a trader strongly believes in an expected outcome, any deviation from that expectation feels wrong. Instead of accepting the new information and adjusting accordingly, they resist it. This resistance manifests in different ways. Some traders refuse to cut losses, holding on to losing positions in the hope that the market will correct itself. Others may panic and exit prematurely, afraid that the market will continue moving against them. These reactions are not based on logic or strategy, but on emotional discomfort caused by unmet expectations. A major consequence of rigid expectations is hesitation. When a trader has been burned by the market failing to meet their expectations, they may become overly cautious. Even when they see a good setup, they hesitate to take action. They fear being wrong again. This hesitation often leads to missed opportunities. And when they finally do enter, they may do so too late, after the best risk-to-reward ratio has already passed. This hesitation is not due to a lack of skill or knowledge, but an emotional attachment to avoiding failure. Another common reaction to failed expectations is overcompensation. After experiencing a loss, a trader may attempt to make up for it by taking a larger, riskier trade. This is known as revenge trading. The logic behind it is flawed. Just because the market moved against the previous trade does not mean it will now behave in a way that favors the new one. However, in the trader's mind, recovering quickly becomes the priority. They expect the market to give them back what they lost. When the market does not do this, the emotional spiral deepens. Letting go of rigid expectations does not mean trading without a plan. A structured approach to the market is necessary for long-term success. However, there is a difference between having a plan and expecting the market to follow that plan perfectly. A trader who understands this distinction approaches the market with flexibility. They analyze conditions, enter trades based on probabilities, and respond to what the market is doing rather than what they think it should do. They accept that not every trade will be a winner and do not let individual losses affect their decision-making process. This mindset shift reduces emotional stress. When a trader no longer ties their self-worth to being right, they experience less frustration. They no longer see losses as failures, but as a natural part of the trading process. They do not fear missing out because they understand that new opportunities are always forming. This detachment allows them to stay focused and execute trades with clarity. Another challenge created by expectations is the illusion of control. Many traders believe that with enough knowledge, they can predict the market's next move with certainty. They might develop complex strategies, analyze historical data, and fine-tune indicators in an attempt to gain complete control. But the market is not something that can be controlled. It is influenced by countless factors: economic data, geopolitical events, institutional trading, retail speculation, all interacting in ways that no individual trader can fully grasp. The belief in control leads to frustration when the market behaves unpredictably. But a trader who embraces uncertainty does not expect control. Instead, they focus on managing risk and executing trades based on probabilities. One of the biggest advantages of removing rigid expectations is that it allows traders to stay in the present moment. Many traders are trapped by past experiences. If they suffered a big loss, they may carry that fear into future trades, second-guessing themselves even when a setup is valid. If they had a big win, they may feel overconfident, expecting future trades to go just as well. Both of these mindsets create distortions in decision-making. A trader who is free from expectation, however, is focused only on what is happening right now. They are not burdened by the past or anxious about the future. When expectations are removed, trading becomes a process of observation and response rather than prediction and reaction. The market is observed without bias. Instead of seeing what they want to see, the trader sees what is. When the market presents a clear opportunity, they take it. When conditions change, they adapt. There is no resistance, no emotional attachment, only action based on probability. This is why some traders remain calm even in volatile markets while others panic. The calm traders have accepted that uncertainty is the only certainty. They do not demand that the market behave a certain way. They do not rely on hope or fear. They trade based on what the market is actually doing, not what they expect it to do. This ability to remain mentally flexible is what separates consistently profitable traders from those who struggle. For a trader looking to break free from the emotional cycles caused by expectations, the first step is awareness. Recognizing when expectations are driving decisions is crucial. The next step is shifting the mindset from needing to be right to managing risk. Instead of focusing on the outcome of a single trade, the focus shifts to executing a series of trades over time. Success is not measured by whether any one trade wins or loses, but by the ability to follow a process consistently. Another key element is self-reflection. Many traders fall into emotional traps without realizing it. Keeping a journal of trades, including the emotions felt during each trade, can help identify patterns. If certain trades cause frustration or hesitation, it is often because expectations were too rigid. Identifying these patterns allows for adjustment. Practicing acceptance is also essential. The market does not owe anyone a winning trade. Every trade carries the possibility of a loss. By accepting this reality, trading becomes less stressful. The goal is not to avoid losses entirely, but to manage them effectively. This shift in perspective makes it easier to move on from losing trades without emotional baggage. A trader who internalizes these lessons begins to experience trading differently. There is no longer a desperate need to control the market. There is no longer an emotional roller coaster tied to wins and losses. Trading becomes a process of probabilities, where each trade is just a small part of a larger strategy. Confidence comes not from predicting the market, but from knowing that over time, disciplined execution leads to success. The impact of expectations is profound. They shape emotions, influence decisions, and ultimately determine trading results. But when expectations are released, clarity emerges. The trader is no longer fighting against the market, but moving with it. This shift allows for consistency, emotional stability, and most importantly, long-term profitability. Chapter 11. Thinking like a trader. In the world of trading, success is not about intelligence, luck, or even having the perfect strategy. It is about developing a way of thinking that aligns with how the market truly works. Most traders approach the market with expectations, fears, and beliefs shaped by past experiences. These mental habits create hesitation, doubt, and emotional reactions that make it difficult to execute trades with consistency. The key to mastery lies in changing how the mind interacts with market information, removing personal biases, and embracing the uncertainty that defines price movements. A trader who has developed the right mindset does not experience emotional highs and lows based on the outcome of individual trades. They understand that each trade is just one in a series and that the result of a single trade has no real impact on long-term success. Instead of feeling fear when placing a trade, they approach it with confidence, knowing that losses are a natural part of the game. This shift in thinking allows them to act without hesitation, following their plan with discipline rather than reacting emotionally to price fluctuations. They do not see the market as something to be controlled or conquered, but as an environment where they must adapt and respond with a clear, focused mind. One of the most important steps in achieving this mindset is accepting the fundamental truth that anything can happen in the market at any time. There are no guarantees, no certainties, and no absolute predictions. Even the best setups, the most well-researched trades, and the most logical market movements can fail. The mistake most traders make is expecting the market to behave in a way that confirms their beliefs. When it does not, they react emotionally, either by hesitating to enter, closing out a winning trade too soon, or refusing to take a loss, hoping the market will turn in their favor. A successful trader does not allow these emotions to interfere because they have trained their mind to accept the unknown. Thinking like a trader means understanding that the market does not create profits or losses. The market simply moves. The trader creates profit and loss based on how they interact with the market's movement. This is why two traders can look at the same chart, enter at the same price, and have completely different results. One will follow their plan with confidence, accepting the outcome without emotional attachment. The other will hesitate, panic, or second-guess their decision, leading to inconsistent results. The difference is not the market, but the mindset each trader brings to the trade. A person who has developed this mindset no longer feels the need to be right. Most struggling traders focus on trying to predict the market accurately, believing that success comes from having a high win rate. In reality, winning traders understand that profitability is not about how often they are right, but how well they manage risk and execute their strategy over a series of trades. They do not attach their self-worth to the outcome of a single trade. A loss does not shake their confidence, just as a win does not make them overconfident. They remain balanced, focused, and committed to the process rather than the outcome. To reach this level of thinking, a trader must change how they perceive risk. Most traders view risk as something to be feared. They hesitate before entering a trade, worrying about what might happen if they lose money. They move their stop-loss further away, hoping to avoid taking a loss, or they take profits too early because they fear the market might reverse against them. These behaviors come from an emotional attachment to money and an unwillingness to accept that losses are a natural part of trading. A successful trader does not see risk this way. They understand that every trade has an uncertain outcome, but over time, following a disciplined approach will produce consistent results. This level of confidence comes from predefining risk before entering a trade. A strong trader does not enter a position without knowing exactly how much they are willing to lose. They accept that loss as a possibility before they even click the button to place the trade. This eliminates the emotional turmoil that most traders experience when the market moves against them. Since the risk was already accepted, there is no fear, no hesitation, and no need to second-guess the trade. The result is a calm and controlled approach that allows for clear decision-making. Consistency is not about having a perfect strategy. It is about executing a plan without interference from emotions. Many traders believe they must constantly tweak their approach, searching for the perfect method that will guarantee profits. But the truth is, any strategy can work as long as it is followed with discipline. Inconsistency comes from emotional reactions. exiting trades too early, hesitating to enter, or taking unnecessary risks after a loss. A disciplined trader does not fall into these traps. They execute their plan without question, knowing that long-term success is built on a series of well-executed trades, not the outcome of any single one. A key element of thinking like a trader is developing trust in the process. Many traders start with confidence but lose faith in their system after experiencing a string of losses. They begin second-guessing their approach, switching strategies, or abandoning their plan altogether. This cycle of constant change prevents them from ever developing consistency. A trader who has mastered the right mindset does not allow short-term results to shake their confidence. They understand that losses are part of the statistical probability of trading. They do not let emotions push them into making impulsive decisions that go against their plan. One of the biggest obstacles traders face is overcoming the tendency to make decisions based on past pain. A trader who has experienced a series of losses may start hesitating to enter trades, afraid of being wrong again. They see a valid setup, but instead of acting, they wait, looking for extra confirmation. By the time they decide to enter, the trade is already moved and they miss the opportunity. This hesitation is not based on logic, but on fear. Fear of repeating past mistakes, fear of losing money, and fear of failure. This cycle keeps traders stuck in a pattern of self-doubt and inconsistency. The only way to break free is to stop letting past trades dictate current decisions. Every trade is independent of the ones before it. A successful trader does not let past pain interfere with present opportunities. Another crucial aspect of this mindset is staying in the moment. Many traders spend too much time thinking about past trades or worrying about the future. If they have recently taken a loss, they may become hesitant or fearful, allowing that loss to cloud their judgment. If they have had a winning streak, they may become overconfident, taking larger risks than usual. Neither of these emotional states leads to consistency. A trader must learn to focus only on what is happening in the present. The market does not care about past trades or future hopes. It only reflects the decisions being made at this moment. A strong trader aligns their thinking with this reality, responding to the market as it is, not as they wish it to be. Letting go of the need to control the market is one of the final steps in developing a professional mindset. Many traders struggle because they try to impose their will on price movements. They believe the market should move in a certain direction based on their analysis, and when it does not, they become frustrated or confused. This frustration leads to emotional trading, revenge trading, or abandoning discipline altogether. A successful trader does not fight the market. They accept it as it is and work within its structure. They do not impose expectations, but instead react with a flexible, adaptive approach. Mastering this mindset does not happen overnight. It requires training, practice, and a willingness to break free from old habits. A trader must recognize and correct emotional reactions, reinforce positive behaviors, and develop the discipline to execute trades without hesitation. Over time, this way of thinking becomes second nature. A trader who has reached this level no longer experiences stress, frustration, or fear when trading. They have complete confidence in their ability to follow their plan and remain unaffected by the ups and downs of individual trades. Thinking like a trader means becoming completely comfortable with uncertainty. It means embracing the randomness of the market while maintaining the discipline to execute a structured plan. It means letting go of fear, hesitation, and self-doubt, replacing them with confidence, trust, and consistency. Those who achieve this mindset reach a level of trading where every decision is made with clarity, free from emotional interference. This is where true success begins.